So wait, online, sorry, I never noticed. I muted myself. Sorry. So, okay, even if I muted myself, you could see what was happening. Topic is fair value measurement. Then down there, we start with key definitions. So key terms or definitions. Number one is fair value. So sorry for that online. So fair value is the first one. And I repeat, we have said, is the price that will be received. The price that will be received to sell an asset will be received to sell an asset or paid to sell an asset or paid to transfer liability, paid to transfer a liability in an orderly transaction, between market participants. Full stop. That is the definition of fair value. But in literal terms, fair value is the market value. Full stop. Helen is requesting I repeat the definition of fair value. What I'll do, because I have these notes here, just proceed, and once we are done, I take a good picture for the entire notes I send in the group. So, look. So 2, active markets. Number 2, active market. Actually, this is a new topic. It was not just given in the new syllabus. Active market, but it was examined one sitting before they wrote this. Is a market in which transactions for the assets, or liabilities, takes place with sufficient frequency, and volume to provide pricing information on an ongoing basis. Full stop. Next, terminology, exit price. Then you say the price that will be received, to sell an asset or paid to transfer a liability. The price that will be received to sell an asset or paid to transfer a liability at the point of sale. Full stop. So exit price is more or less the same with fair value. The only difference, fair value is just the normal market price. So the normal market price, if you say that this product is going for 1,000, that is the market price. But you can negotiate so that you can even buy it at 900. So if you pay 900 to take that product, then that is called what? Exit price. So exit price is just the fair value, but now it is the actual amount which is paid to transfer or to acquire an asset. Next, highest, there's a term we normally use here called highest and best. Highest and best use. Equal to highest and best use. Then you say, is the use of a non-financial asset, the use of a non-financial asset, use of a non-financial asset by market participants. By market participants, that will maximize the value of the assets. That will maximize the value of the assets. Will maximize the value of the assets. Next, most advantageous market. Most, from the word advantage, most advantageous markets. Most advantageous market, you say, is a market that maximizes, the amount that will be paid, will be received, sorry. Maximizes the amount that will be received, the amount that will be received to sell an asset, maximizes the amount that will be received to sell an asset, or minimizes the amount that will be paid, minimizes the amount that will be paid to transfer liability. The amount that will be paid to transfer a liability will be paid to transfer a liability. Full stop. The last one, principal markets. Principal market. Principal markets. Then you say, is a market with the greatest volume, and level, the greatest volume and level of activities, is the market with the greatest volume and level of activities for the assets and liabilities. For the assets and liabilities. For the assets and liabilities. Full stop. Subtopic there, fair value hierarchy. There's a subtopic after the definitions. Fair value hierarchy. Fair value hierarchy. Hierarchy ni nini kwa Kizungu? Huh? What is an hierarchy? Ati hierarchy ni nini? So you write and say IFRS 13, what a story. No? IFRS 13, 6. IFRS 13, 6 to increase consistency. 6 to increase consistency and comparability. And comparability in fair value measurements. in fair value measurements and disclosures through right this way, through a fair value hierarchy. Through a fair value hierarchy. I think I need to explain something small to that effect. So you know fair value, I think class has a measure here. Fair value is the market price. There are some prices which are normally controlled. Petroleum side, petroleum side. The normal super is 113. 130. Yes. That price is normally controlled. You can also, if people are selling at 130, then at least you go 130, 131, 129, 132 because of geographical areas. But wewe unauza kwenye diskia yako hata ukiongea vizuri unaweza uziwa hata 50 bob per liter. The price is controlled. So there are some prices which are controlled. Even if you own the product, the prices are controlled. There are some which are not controlled in active. There's what we call the active market. Active market is a market whereby the prices of goods and services are determined by market forces and the transactions are considered to be of the highest volume. So when setting prices, we have what is called the market price hierarchy or the fair value hierarchy of classifying the market prices. That is what the standard tries to check. Another hyphen you say, fair value hierarchy categorizes the inputs, used in valuation techniques, into three levels. Full stop. Another hyphen. The hierarchy gives the highest priority. The hierarchy gives the highest priority to quoted hierarchy to quoted prices in active markets. Quoted prices in active markets for identical assets or liabilities, and lowest priority to an observable inputs. Full stop. I want to use a certain question to discuss some issues. Check for me 2021, September, class sitting part 1. September 2021, just open your papers. I want to online to repost the past paper for those people who joined and they have not received the past papers. Section 5. So I've reposted the past paper there. I've posted. So let's go to the past paper. Which question in 2021? 5B. So go to September 2021 page 17. Check page 17. This is a market value. There is none. After what we have been writing, what you can ask is only the definition. So check for me that question of September 2021, question 5B. Question 5B. Question 5B, page 17. So I have to go direct to the page without struggling. So, and I can confirm that 5A is a topic we have covered. So that was our first topic. Make sure you have the notes. That was our first topic. We covered it. Make sure you have the notes. So 5B, if we may read, it says, International Financial Reporting Standards IFRS number 13, fair value measurement, provides extensive guidance on how the fair value of assets and liabilities should be established. Yes, it gives guidance on how to determine the market value. Fair value is the market value, how to determine the market value for an asset or liability. So when we talk of liability, the amount at which it should be settled. So that one we know it gives that guideline. So required, with regards to the International Financial Reporting Standards IFRS number 13, briefly describe the fair value hierarchy of inputs for arriving at fair value, 6 months. So it depends. When setting the prices for inputs are those products, you check, it is a quoted market, and those markets whose prices are controlled. The controlled prices most so by the government. Then we come to a market which is quoted but not active, and one which is not quoted and it is not active. So write for me there, below that question, you write, what do they want? What's that name? What is the question? Briefly describe the fair value hierarchy of inputs. So right there, hierarchy levels. Hierarchy levels. Hierarchy levels. Hierarchy levels. So we have 3 levels. We have 3 levels. Number 1, level 1 is what we call level 1 inputs. Level 1 inputs. So for level 1 inputs, you say this relates to quoted prices. Quoted prices are those which are controlled, and mostly by the government. This relates to quoted prices in active. Quoted prices in active markets. In active markets for identical assets. In active markets for identical assets or liabilities that the entity can access. That the entity can access at the measurement date. Can access at the measurement date. Full stop. Hiyo story yote mnaweza sahau. What you should not forget, the keywords for level 1 is the quoted prices and the active markets. Those two, you can do whatever you want with it. Those are the key issues. So even if, provided you have said level 1 inputs and you say relates to quoted prices in active markets, that is okay, without bringing all those stories. So it relates to quoted prices in active markets. And we know what are active markets from our definition up there. Let me check up there. What did we write is active markets? Is a market in which transactions for the assets or liabilities takes place with sufficient frequency and volume to provide pricing information on a EU story in big. What can you summarize to be an active market? A market with, we can even say with significant what? Transactions. There is. Ama unaweza sema hii kana yote kuna siku inaweza pita. Inaweza pita bila watu kununua kitu kama petroleum products. Watu bila kuweka fuel. It is possible. But it is there, but customers are not there. Can it be possible? No. But a day can pass without what being sold in the whole country. Unajua, in this country, there is a group and section of people wenye wanakulanga panya. Are you aware? Are you aware? Yes. Not in this country, but even in Africa. See, Africa, there's a place wanakula panya. But now, when we talk of Africa, Kenya inaweza pita bila hiyo panya kuuzwa. So that one is not an active market. Active market is where transactions take place every day. So if the price is controlled in an active market, then that is called level 1 input in the hierarchy. Hierarchy level 2. So you say level 2 inputs. Level 2 inputs. Level 2 inputs. Level 2 inputs. You say these are inputs. Inputs in markets. Inputs in markets other than quoted. Other than in markets. Other than quoted market prices. Quoted market prices that are observable either directly or indirectly. Observable directly or indirectly. Full stop. Examples are quoted prices. Examples are quoted prices for identical, quoted prices for identical or similar assets. Identical or similar assets in a market that are not active. In a market that are not active. In a market that are not active. Full stop. Let's go to level 3 inputs. Level 3 inputs. Level 3 inputs. So the prices can be quoted, meaning they can be controlled, but the market is not active. So when if you control the market data, you say these are inputs which are unobservable, and relates to markets which are neither quoted. Relates to markets which are neither quoted, neither inananga na kizungu gani? Nor. Neither quoted nor active. Neither quoted nor active. So they are just markets which are there. The government does not control. Market also is not active. Those are level 3 inputs. Full stop. Subtopic, which I think a subtopic which I suspect, if they will bring that theory, this one is the one they can bring. Valuation techniques for fair value. Valuation techniques. Valuation techniques for fair value. So valuation techniques, how the government, when they are coming up with the prices, how do they come up with those prices? So we have 3 techniques for determining the market price. And I don't want us to write that kizungu, that there are 3 methods they include upon. Let's just highlight them, the techniques. So valuation techniques for fair value. 1, we have the market approach. We have the market approach. 2, we have the cost approach. 3, we have the income approach. Yes. That one they can ask you anytime from now. I've said this topic is new, by the way, in the syllabus. Another one you release the levels. The only thing which is, there are only three things you can be asked. Apart from those definitions, they can ask you three issues: the hierarchy, the techniques of determining the fair value, and three, the disclosure requirements only. So let's start with market approach. Market approach for determining fair value. Just like market approach. Which I know you know. Unaenda tu kwa soko unaangalia ni pesa ngapi, then you say that is now the price. So you say it uses the prices and other relevant information. It uses the prices and other relevant information generated by market transactions. Eunice, are you writing? Generated by market transactions involving identical, comma, comparable, or similar assets, comma, liabilities, similar assets, liabilities, or group of assets and liabilities, or group of assets and liabilities. Group of assets and liabilities. Full stop. Allow me to repeat. It uses the price and other relevant information generated by market transactions involving identical, comparable, or similar assets, liabilities, or group of assets and liabilities. When you are using the market approach, then the fair value of assets or liability is considered to be the price of similar assets or what? Liabilities in the market. That is the market approach. Just check the market forces. What is the market saying? That is the fair value of that asset. Number two, cost approach. Cost approach. Najua results zilitoka, so watu bado wana absorb, si ndio? But you know, Kenya is a very funny country. Sometimes hata sasa wacha tu console labda ameanguka. Sometimes unaanguka tu as a result of corruption. And you know which corruption? There is something actually tumepiga kelele. You find that Kasneb and I have to say this, the current CEO we have, he does not know what he's doing. He believes that for you to set Kasneb down, you must be called a doctor. Dr. So-and-so, and are you teaching in UN? Eh? So those people, they don't understand how CPA line is moving. If you check, actually there's a serious complaint people are raising. If you check like a paper they examined in this class, section 5 MA, it was completely out of what people are supposed to be taught in the syllabus. Completely out. Atibora tu imesetiwa na mtu ako na nywele ya white, na amevaa specs, na ako na tumbo kubwa, bas. Huyo anaweza sema. Na anasema vitu tu irrelevant. Completely irrelevant. So what leads to that? Because atione kazi ya mtu mwingine. Those are the problems. So sometimes tumeanguka because mtu alifanya kitu ndio set hiyo mtihani ndio. Mimi wakiseti yangu vibaya tunaenda kurusha mawe. Sio? Tunaenda hapo. If they said something out, hatuwezi kubali. Kama hiyo that one was totally out. That was out of context. So yetu itakuja vibaya. We hope lazima ikuwe mzuri. We have complained. Let's proceed. So they will not bring anything out of the syllabus. Now they're going to be serious. People have raised a lot of complaints. Cost approach. cost approach, you say it considers the amount. It considers the amount that will be required. Amount that will be required currently. Mwingine ameongeza na huyu mtu mwenye na set lazima kuwe na kipara. It considers the amount that will be required currently to replace the service capacity. To replace the service capacity of an asset. The service capacity of an asset, in brackets, current replacement costs. Current replacement costs. Current replacement cost. So the value of the asset becomes the amount which you can incur to replace similar asset. So the replacement cost becomes the cost or the value, the market value of the asset. So that is the replacement cost. Finally, income approach. Income approach. Income approach. Then you say, under this approach, the future amounts in bracket, cash flows, income and expenses, under this approach, the future amounts in bracket, cash flows, income and expenses, close the bracket, are converted to a single current amount, in bracket discounted, close the bracket, to reflect the current market, expectations. Current market expectations about those future amounts. Full stop. So income approach, you do it as per the standard definition, but income approach, you just check how much, how much does it generate in a year? Then you say useful life is 10 years. In 10 years, it can generate this. Then you determine the present value. So for income approach, we check the expected future cash flows. Then we discount them to present. That is the income approach. Disclosures. Then you say IFRS 13 requires an entity. IFRS 13 requires an entity to disclose information. IFRS 13 requires an entity to disclose information that help the users to assess each of the following. So those following are the disclosures. To assess each of the following. Number one, the hierarchy. One is the hierarchy of fair value. I.e., the category of inputs. The hierarchy of fair value, i.e. the category of inputs. Inputs, we have how many levels? 3. So whether it falls in 1, 2, it is in quoted and active or quoted and not active. Then 3, the fair value for each category. 2, yes. The fair value for each category. Fair value of each category. of assets or liabilities. Fair value for each category of assets or liabilities. Full stop. Full stop. So you msome, they are likely to ask you three serious issues there: the disclosures. They ask you about the technique for determining the fair value or hierarchy, or maybe those definitions, but the definitions I really don't think, but those three, make sure you can be able to answer some. Now let's move forward. We are moving forward again to a new topic from section 3, pulled from section 3 to this level, accounting for leases. Leases are now here. We never used to work out leases in advanced part. So leases, accounting for leases. That is our next issue. So that is IFRS number 16. Accounting for leases. So a lease, we are not writing. You don't know, almost 2 pages. So a lease is just an agreement where one party gives out an asset in expectation for what? Installments from the other party. So the question will be, one, we have two parties involved. We have the owner of the asset. The owner of the asset is called who? You are saying this one. Then the one who takes over the asset, the C. Okay. He wanted us to work well. So let's start. What is the correct one? Whichever, sio? Watu wa kizungu wanasemanga Lisa. But the correct pronunciation is Lease. That's how it is. It sounds funny, but that is how it operates. So the issue will be, how should we account for it in the books of the lessor and in the books of the leaser? Then what happened? Let's see. What happened in 2019? The standard was reviewed. Those of us who are in the audit firm can really confirm very fast. We have two types of leases. We have what is called an operating lease and a finance lease. But in the 2019 review, all leases are supposed to be accounted for by the lessee as finance leases, regardless. Then from there, the owner of the asset, if the asset reverses back, you will be able to account for it correctly. So what I want to do, we have so many issues here with some key terminologies and the rest. I think these notes are very visible. Now to be a mwandike within, as I go for break, I think within 10 minutes you can be done. We discuss them, then we do the related questions. There are a lot of questions in this which we will cover. So let me send you those notes. Mwandike bio instead of wasting time here dictating them. Then we're going to repeat. So just open the group. I get you clear notes on this. And by then, if you don't have the previous notes, you can tell me. I think I got some for last semester, which are quite good. So let me send. But make sure you are writing them very fast. This one be visible, yes. So can you write those notes very fast? How many minutes do you think it can take? At that? I'm at class 7 to discuss and do some few questions. Okay, I hope everyone is in attendance, because lease, if you don't have that good concept, it can bring a lot of problems, computations. But I know now kuna fellow Kenyans, wamesema hii skill notes tumetupiwa. Mimi niandike now. Make sure you are writing. There is power in writing. Conveys. Under conveys. Yeah. The right to use. A lease is an agreement where one party, lessor, conveys to the lessee in return for payment or series of payments the right to use an asset for an agreed period of time. And now we go to key terms. Commencement of the lease term is the date from which the lessee is entitled to exercise the right to use the leased assets. Inception of the lease is the earlier of the date of the lease. But you remember 30 minutes apart. Musiandike hiyo illustration. Kuna illustration hapo chini. I think I made them in form of handouts. Let me just check. Don't write the illustration. Fike tu hapo, but the illustration don't write. The last one. Think out those questions. The last semester, that was a question. Esther says she cannot see the notes anywhere. Esther, have you seen it now? Please confirm. Are you in the group, Esther? Are you in the group? Just confirm that. Are you in the group? Esther is in the group but cannot see the notes. How possible is that? Esther, kama una WhatsApp kwa online hapa, in the class group. Esther. So what do we do? I've even sent the question twice. The notes. Esther, you can give us your number there, then someone can forward to you, or I can forward. No, someone can. No, wake up and forward. Kingoja anyone, people are writing. So let me forward. But I don't know why you cannot see. Sylvia is telling you, are you in the section 5 group? Everybody doing FR should be in section 5 group. Or we are checking section 6. Check section 5. But meantime, let me send us you 875 as you. Or early morning for sec 5, I get. So Esther, you can check, share. I'm being informed that the person using the name Hustle a Nation to use the correct names. Hustle a Nation. Yes, that person using that name online. Naitwa Hustle a Nation. That use your name. Watu wa online watakutoa from the reception. So kindly use your name. Hiyo inaweza kwa jina ya done. Use your correct names. They will remove you from class, so it will interrupt you. According to Judith, that it would have been better if you could have dictated. There is power in the voice. As your voice to discuss. We are going to discuss everything you are writing. Which one is better? Dictating. So dictating online, you are someone. Moving into the future will be dictating, but this one just finished. Umaliza. Umemaliza? Are you done? Well, okay. Online, once done, kindly let me know. Some people are still right. Now is done. So leases, the way I've said, it is borrowed from section 3. It was not here before. So a lease is an agreement where one party, who is the lessor here, conveys to the lessee in return for payment or series of payments the right to use an asset for an agreed period of time. So key terminology is one, commencement of the lease. But is there a difference between commencement and inception? In reality, many people confuse between the two. Is there a difference? Huh? Commencement and inception. Which one comes before the other? Inception, sure. So commencement is the date from which the lessee is entitled to exercise the right to use the leased assets. Then inception of the lease. Inception is the earlier of the dates of the lease agreement and the date of commitment by the parties to the principal provisions of the lease. So you have just agreed, but you have not been given the asset. That is called inception. Then once you start using the asset, you have the right to use the asset, then that is now the commencement. Economic life is the period over which an asset is expected to yield economic benefits to an entity. Contingent rent is that portion of the lease payment that is not fixed in amount, but which is based on certain future factors, e.g., percentages of future sales. Contingent means subject to. Gross investment in the lease, it is the minimum lease payment receivable by the lessor under a finance lease and any unguaranteed residual value accruing to the lessor. Then unguaranteed residual value is the portion of the residual value, residual is at the end, of the leased assets on which the lessor is not assured to receive at the end of the lease term. That's why we call it unguaranteed residual value. Then guaranteed residual value is that part of the residual value that the lessee will have to pay the lessor at the end of the lease period or the lease term. Interest rate implicit in the lease is the rate of interest that the lessee would have to pay, having taken into consideration the present value of the lease payment. So that is the discounting factor, because the installments will be based on future. So the rate which you will be using for discounting purposes, you will find the examiner calling it implicit. Then lease incremental borrowing rate is the rate of borrowing on similar terms and on similar assets. Types of leases, we have finance lease and operating leases. So finance lease, a lease is classified as a finance lease if it transfers substantially all the risks and rewards incidental to ownership to the lessee. That means at the end of the lease period, the lessee can become the owner of the assets at the end of the day. So form of a lease which gives rights of ownership to the lessee is a finance lease. So characteristics one, it transfers ownership of the assets to the lessee by the end of the lease term. Kama hii mkimaza CPS hai, uachimu kwa section 1 calculator yako on a lease agreement that every week, ukiacha mtu calculate every week, unaweza kuwa na mchaji pesa ngapi? 50 bob. 50 bob every day. Akimaliza section 6, bado utamwambia now bring it back, I want to give someone. There is high chances that asset will transfer. So form of a lease in which ownership will be transferred to the lessee, that is a finance lease. Then 2 characteristics, the lessee should have the option to purchase the asset at a price lower than the fair value. At the date the option becomes exercisable. That is at the end of the lease term. So you are given the option to purchase the asset at a price which is lower than the market value. Then the leased assets should be of a special nature, such that the lessee can use them without major modifications. To serious, asset 2 weeks and other. Then the lease term should form a major part of the economic life of the asset, even if the title is not transferred. What that means, if the useful life of the asset is 5 years, at least the lease period should form a major part of the economic life. But it may be year 1, lease period to go for 5 years or 4. You don't give in year 4 when the economic life will end in year 5. Then you say that now the lease period, you give in year 4 to the end of useful life, then you say that now the lease period will be 10 years. It means that person will be using the leased asset even when the asset is completely written off. Operating lease. Operating lease is any form of a lease other than a finance lease. That is the standard definition actually. Any lease which is not a finance lease is an operating lease. The title of ownership is retained by the lessor during and after the lease period. Like these houses we rent in urban centers where people stay. That's an operating lease. I will pay rent for 10 years. Then unless it is rent to own. So unless it is on that term, then that's a finance lease. But if it is this other one where the then now that is an operating lease. The title of ownership reverses back to the owner of the asset. Risk and rewards are not transferred to the lessee, and all the incidental costs are to be incurred by the lessor. NB, in the new standard IFRS 16, both operating and finance leases are accounted for as finance leases. However, the lessor is expected to account for the leases separately. So the owner of the asset here, but for like a quick one, this premises where Destiny is, of course, it is a rented premises. So to the landlord, this is an operating lease. The title of ownership will revert at the end of the lease period. But in our books, we account for it as a finance lease. By that time, if you reverse the book, so you just account for it as if the asset is yours. So the amount you expect to pay, you recognize what is called the right of use. Then you capture how much are you expected to pay, then you recognize in the book. So the lessee, even if the asset is the title of ownership will be retained only to revert, it should be counted for as if it is a finance lease. So accounting for finance leases by the lessee. But before I go there, what do you think? What is the main difference between a finance lease and a mortgage? Mudon is asking that question. You know how mortgage operates? How does it operate? You acquire the asset. Then you pay for it. Then when you fail, it is repossessed. So mortgage and finance lease are more or less the same. The only differences are the conditions which are attached. Because in a mortgage, you obtain the ownership, then you honor the obligation to pay. But in a finance lease, you don't own the ownership until you complete the installments which you are supposed to pay. So they are more or less the same. What makes the difference is the condition of ownership. This other one, the ownership is immediate. then you finish the obligation. This one, you finish the obligation for finance lease, then the ownership comes. So in mortgage, ownership comes before you finish the obligation. So the conditions are what makes them different. So how do we account for finance leases in the books of the lessee? Because lessee will account for finance lease regardless. So upon lease commencement, a lessee should recognize a right of use. That right of use, please make it in quotes, is a key issue there. Is a right of, upon lease commencement, a lessee should recognize the right of use assets. That's how it goes, right of use assets and an obligation in the statement of financial position. So as being in digital era, Google, right of use assets. What does the Google community have to say about it? Just put this, right of use asset. Because they are saying when you lease an asset, this is what you're supposed to recognize in the financial statement. So what is right of use assets? If you get, you just read for us. Right of use assets. Right of use assets. It represents the lessees to utilize the leased what? Item. That is the main issue. Right of use asset is the authority to the lessee to use the leased item. But now in the financial statement, you recognize the value of that asset. It was this, you capture that in the books, then you amortize as time goes by. So back to our notes, right of use asset is considered to be the value of the leased asset less the accumulated depreciation. So the value of that asset is the right of use. So illustration, time will allow, maybe. Illustration. So online I've sent. So Esther, now I have to send you this one. So online I've sent you the illustration. Basically, you can have the copies. So online check. There's a question I've forwarded. There's a question I've forwarded. So in illustration, we were not having illustration questions because the topic was borrowed from section 3. So all those questions before which you can see there, we borrowed them from section 3. But last sitting, there was a question on leases. So we'll do it at the right time. It's covering something which we have not checked. So we have to check that at the right time. So meantime, these are what we have to use. So let's go to question 1 on this handout. Question 1 on the handout, it says, on 1st of January 2019, JM Limited leased a machine from GT Machine Limited under a finance lease agreement. JM Limited was to make installment lease payments of shillings 14 million every 6 months on 30th June and 31st December in arrears. The first payment was made on 30th June. The first payment was made on 30th June and 31st December in arrears. You see repetition? Is a repetition. The first payment was made on 30th June 2019. The fair value of the machine was shillings how much? 60 million with an estimated useful life of 3 years. Okay. The interest rate implicit in the lease was 10% per 6 months. Required extract of the statement of profit or loss for the year ended 31st December 2019 and 2020. Then extract of the statement of financial position as at should be as at 31st December 2019 and 2020. So I hope we can do that within 10 minutes, sure. So write for me there before even we start that illustration. Remaining minutes will not even allow us to complete that. I started to the review, so there's something I want to write for me. Write down there. Write for me down there. Steps. Couple steps. Steps for accounting. For accounting, should be of accounting for finance leases. So how do we account for it in the financial statements? So step one, step number one, identify the lease. Identify the lease. Of course, I don't want many stories. Identification means you identify whether it's a finance lease or an operating lease. So like this one is a finance lease. For what reasons? What do you think makes it be a finance lease? From the characteristics, what will make it be a finance lease? Lease period. Lease period, please. Lease period is 3 years. Okay, lease period is 3 years and useful life. Ama wajasema lease period. Lease period, they have not said. Are you sure? On that, they list a machine from JT and I find out ama walisema. Okay, so here they have stated that it was a finance lease. However, the easiest way to identify, you check the lease period, they'll tell you the lease period was maybe 2 years, and the useful life of the asset is 3 years. So if it forms that major part, they should not say useful life is 3 years and the lease period is 4 years. The lease period should not be more than the useful life. It should be at least junior useful life. So that one makes it be a finance lease. So you identify the lease. Then in step two, determine the present value, PV, the present value of the minimum lease payments, the lease payment. Step three, compare the fair value of the asset, the leased asset, fair value of the asset, and its present value, consider whichever is lower. Whichever is lower. That one I will, but I can explain still. The market value is 60. Huyu mtu anakuambia utalipa every 6 months you are paying how much? 14 million. So 14 million, it means not even it means we pay for how many installments? Yeah? I think 2, eh? So which is 1, 2, 3, 4. So 2 years, which is 4. So if you multiply this by 4, that one comes to 56. Determine the present value of that 56, then you compare with the current market price of how much? 60. Then the lessee will negotiate for whichever installment it goes to. That should now be the lease. The value of that lease what? Asset. You compare. If because you are telling me I'll be paying this, what is the current value? Because I will be 14, that is 56. Currently, the market value is 60. So I will negotiate. So in the exam, hakuna option ya kuambiwa to negotiate. Once you get whichever is lower, we assume that will be the cost of the asset. So that is the consideration of whichever is lower. Then step 4. Step 4. Depreciate the value in step 3 above if the asset is depreciable. Then step number 5, you prepare lease amortization schedule or lease repayment schedule. And finally, step number 6, you prepare financial statements extracts. So these are the all. So examiner, amefika step 6. This is what they have asked. You have to follow all these steps. I don't say in the exam step 1, step 2, step 3, step 4. You just do them. By the time you have 1, 2, 3 questions, you'll be okay. Let me answer some questions here. What's the difference now? While discounting, is this an annuity? For leases and mortgages, you don't consider that an annuity. Just use because they are being paid in arrears for that year. Just work for each year separately. Then the same Mudoni, you said, how do we recognize if it is a financial or operating lease in a question? Whether finance or operating lease in the new standard, the lessee accounts for all of them as finance lease. That is what the standard requires. At the end, if the asset is repossessed, you check how much is remaining, you reverse in the books to cease that liability. So like right now, I was giving you an example of the college. The college will say that we have a lease period, maybe with the landlord, let's say 10 years. So you check within these 10 years, how much in total will you be expected to have paid? So you say we are expected maybe to pay whichever, maybe 60, for example. So that 60, you amortize it as time goes by. So in year 1, if you pay out of 60, you have paid 5, you amortize, then you get the outstanding balance. So outstanding balance is what now you capture in the financial statement as a liability. Now that is the right to use. So I think with the question, Mudoni, you will be able to see how it is done. So an example illustration, handout question 1. Illustration, handout question 1. That is where we'll start from. So the lessee account for all leases as finance lease. The lessor separates the two of them. may account for them separately. We shall tell you as time. So thank you. Let's meet on Monday. And we want to start gaining momentum. For fair value measurement. Our class comes to an end. Online, you can log out.